Hi, everybody. Hi, everybody, and welcome to another webinar of our series. Today, we're going to go ahead and discuss or present two key technical indicators, and more specifically, two key technical indicator strategies that are super beneficial. You could, in a sense, apply to your charts and understand what kind of information they convey. They're going to be RSI and Bollinger Band strategies. These are super simple. We have covered these technical indicators and how they work in prior webinars. If you have any sort of query of how they work and what information they convey, you can go ahead and watch that on YouTube. Today, we're going to do again a small recap of what information goes into them and what information we can, in a sense, get from them once the data is computerized by the usage of these technical indicators. Again, it's going to be RSI and Bollinger Bands, and we're going to do a few strategies on each and every one of those. And hopefully you're going to learn something from this and use it on your day-to-day kind of trading journey. For the time being, we're past our time. Let's just jump straight to the point. So this is a quick risk warning and a disclaimer. I'm not going to go over this. The point is that there's no investment advice or investment recommendation data in this kind of webinar. It's for purely educational purposes only, and the redistribution of the material is strictly prohibited. So let's begin with the Bollinger Bands. So Bollinger Bands was a technique developed by a guy named, surprise, surprise, John Bollinger back in the 1980s, where at the end of the day, we have a technical indicator that uses two bands, more specifically uses a moving average and applies two bands, one above and one below. And these bands are calculated using what we call the statistical kind of concept, the standard deviation. So in essence, you can clearly see that the upper band is the X amount of moving average days you want, X amount of days in the rolling moving average. So in this kind of example, we use a 20-day moving average or 20 period, whatever that is. And you add onto that two standard deviations, and you get the upper band, and you have the lower band, which is the same moving average, the 20 period moving average, and you subtract, two standard deviations from it, and you get the lower band. The point here is that by the usage of the standard deviation, the technical indicator computes, in a sense, the predictable 95% of the time where the price action, how fast and how far price action could go, which depending on the volatility is going to create those bands. And by using two standard deviations, we are at the end of the day looking at the remaining 5%, which are, in a sense, breaks above or below the upper or lower bound of the Bollinger Bands, which are those from our point of view, given that we use two standard deviations, the extreme kind of scenarios that tell us that the price action has went way ahead of itself. Okay, so the price action, there's no resistance from the opposite party, whether that is the bulls pushing the price action to higher ground and higher and higher and higher. In the absence of the bears, at some point in time, the move gets saturated, and this can be shown by a break above the upper bound of the Bollinger Band. The same can also be true for the bears when they are in control, when there is no side of the bulls to contain the fall of prices. You can see a break below the lower band of the Bollinger Bands. But at the end of the day, with the usage of Bollinger Bands, we look for that 5 remaining percent of the extremist moves, in a sense, because at the end of the day, we use the principle of the reversion towards the mean. That means that whenever you have an over-exaggerated kind of price action, we tend to see, from an observational point of view, that price action tends to move back towards a center line or a midline or an average line. So that's why we use the Bollinger Bands. That's how we use the Bollinger Bands. In a sense, we look for the breaks above or below, and we extrapolate from there onwards that the opposing party is going to take the initiative and correct the overextended kind of move either to the upside or to the downside, depending where the break was. Okay, so this is the main concept of how Bollinger Bands are being used. So Bollinger Bands at the end of the day measure volatility of an instrument under study, and when the market becomes more volatile, we tend to see the bands moving further apart, so they widen, and during quiet periods or periods of consolidation, we have the bands contracting. Okay, so the closer the prices move to the upper band, we tend to say that the market is overbought, and the closer the prices move to the lower band, the more oversold the market is. So upper and lower bands can also be used as price targets. And this is a visual illustration of how the Bollinger Bands are working. But before we go into the chart and get the visual illustration, let's just go ahead furthermore and analyze a little bit more how this is computed and what kind of information it is contained within these messages. So Bollinger Bands, again, is a technical analysis tool invented by John Bollinger in the 80s. So having evolved from the concepts of trading bands, which are in a sense a moving average, and you have a fixed amount of bands either above or below, so that might be 5%, 10%. It's fixed, it's not dynamic like Bollinger Bands. This concept was created by John Bollinger to measure highness of the loan or the lowness of the price relative to previous trades. Okay, so the thing to remember is that trading bands are fixed, whereas Bollinger Bands are much more dynamic in nature, because they incorporate the concept of volatility within it. Okay, the concept of standard deviation is calculated on the moving average compared to the trading bands, which are just a fixed percentage above or below. So the Bollinger Bands are consisted of a middle band being the sample size period you choose of your liking. So whether that is 20 period moving average, 50 or 100, 200, whatever that is. That is the midline. The upper bound is again the same moving average plus 2 standard deviations. We just mentioned this. So, and the lower bound is the average period we chose, the moving average minus 2 standard deviations. So the default choice for the average is the simple moving average. However, in recent times, we have seen the rise of the usage of the exponential moving averages, which are indeed a common second choice. Maybe they are the first right now, mainly because the exponential moving average places much more weight on the more recent kind of trading days or trading periods compared to the simple moving average, which is in a sense, let's just say, we're talking about a 10-day moving average. You add 10 of those parameters together and you divide that by 10, you get an average. Exponential moving average places much more weight on there. Let's just say the most recent 4 or more recent 3 periods, which gives you a much more accurate representation of what is happening again in the recent past. Again, these are not future predicting indicators, they are lagging indicators because they use moving averages. Okay, so moving averages are inherently lagging indicators because they compile information about the past or from the past. Okay, so don't treat this like again a crystal ball that is going to tell you where the price action is going to head towards to next. Okay, so interpretation, the use of Bollinger Bands varies widely amongst traders. So some traders, this is on the strategy part, some traders buy when the price touches the lower bound of the Bollinger Bands, and the exit when the price touches the moving average, the center line of the bands, the midline. That's one way to do it. Other traders sell, for example, when the price breaks above the upper Bollinger Band, but they anticipate a correction when the move goes on the other side, which is on the lower half, if you would like, or expect to see the break below the lower band of the Bollinger Band in order to cover their position. So there are plenty of ways to do this. We're going to do the strategy together in a few minutes. So when the bands, again, something else to remember is that when the bands lie close together, a period of low volatility in trading instruments price is indicated. That means low volatility, consolidation, no price action, nothing volatile. Pretty much the bands become super, super tight and they fix on top of the price action. Whereas when they fall apart, this is an indication of high volatility and high liquidity around that kind of instrument. And this is probably where the most promising kind of plays can arise, okay, upon the rise of the volatility. So when the bands have only a slight slope and lie approximately parallel for an extended period of time, and they oscillate up and down between these two bands, this can be treated as a channel, which is super important as well and super useful, because you can, if you do identify a channel at the period of inactivity, you can sell at the top and buy at the bottom. Pretty easy to do so up until the point we see a break. So finally, traders are often inclined to use Bollinger Bands and other indicators to see if there is some sort of confirmation. We've stressed this fact many times. Now, please use many different other or multiple indicators that are conveying different but synergistic information. And once these kind of indicators kind of align and they come together and they tell you the same piece of you come to the same conclusion using these indicators, then you have much more confidence that your assessment is correct. It's not 100%. It's not something, and there is nothing sure in financial markets. Things can go wrong in an instant. So please treat this with the analogous kind of attention or approach. So don't expect to see 100% of confidence when it comes to your trading journey. So if you have anything above 51, the higher you get, the better it is. So mainly if you have, let's just say, a 70% chance of confidence, 70% confidence that the play is going to go to either direction, you're in very good hands. You can do 80, depending on the information you have in front of you and the technical indicators. So at the end of the day, you could easily combine a technical indicator, which is a non-oscillator, with the Bollinger Bands, which is an oscillator. For example, trend lines and chart patterns and all that kind of stuff for support and resistance levels. And you can increase the probabilities of you making a successful and correct trade. So can't stress this enough. So let's go back to the example. Visual illustration of the Bollinger Bands. What we look for here are the breaks. So clearly see one break here. Okay, price action grows from here. Basically, let's just first identify the trend. Obviously, downwards, you see consecutive highs and consecutive lows, lower highs and lower lows, excuse me. So you can draw a lovely trend line, let's just say from here, something like this. Okay, direction is certainly on the downside. So we have already a sell bias on this kind of trade, which is what dollar yen chart. It's an old example, but still serves a purpose. So we look for touches, or we expect to see the price action being confined below this line, even though it's not straight. Below this line, since we want to continue on saying that we have a sell bias, okay, much more clear. So you could treat this in one way. So this is one strategy to go ahead and do so. So you see the price action forming a lower high here, a lower lows here, excuse me, and then an attempt to switch and move to higher ground. However, you see a failure, but also you see the break above the upper bound of the Bollinger Band. We extrapolate from here onwards that the price action is going to revert back towards the mean. The mean is, in this kind of case, this line here, the bid line. So after we see the break above that and we see price action reversing, so the first two candles, if you would like, you see the complete reversal of the move, the peak and the fall. Once again, we can do a sell position here in accordance with our bias, okay, and have target the midline for an exit. So this is a distance you could have covered, okay, or the other strategy is wait for go short or sell in this kind of level and await for the next time you see a break below the lower band of the Bollinger Bands, which is somewhere in here. So much more profit opportunity taken here in this kind of example, much more distance covered by the price action, much more profit, but it's going to take a little bit more longer. But that's one way to go ahead and play this, okay? So break above the upper bound of the Bollinger Band, you extrapolate, you make the assessment that you in a sense come to a conclusion of what kind of bias you have. So in this kind of case, we had the selling bias. So because the price action forms lower lows and lower highs through time, okay, across time. So I wait for the upper bound of the Bollinger Band to be broken, and then we go short and you cover the position somewhere in here, okay, and close this. You could, at the end of the day, play the opposite side as well. So when you have a long, when you see a break below the upper bound of the Bollinger Band, you go long and you have, once again, your target being the midline as an exit. Okay, that's one way to do it. Or I wait for the break above the upper bound of the Bollinger Band, which has never happened because it's much more harsher, much more difficult for the price action to break above the upper bound of the Bollinger Band on a consistent manner, if and only if the price action is heading to lower ground. So there is an asymmetrical kind of takeaway from this kind of example, is because since we have a sell bias, you expect the price action to fall much faster compared to the price action to rise. Okay, so you have to keep this in the back of your mind as well. So you could have an aggressive sell bias by going short when you see the break above the upper band of the Bollinger Band and cover your position on the lower end or the lower break below the lower band. Okay. Whereas you cannot have the same kind of approach when you go on the opposite direction. That means when the price action breaks below the lower band of the Bollinger Band, do not expect the price action to, you could, but your chances are much less for the price action to cross the midline and then cross the upper bound once again. So a modified strategy could be when you have a sell bias to open a position on the lower band when you see the break below the lower band of the Bollinger Band and cover your position at the midline instead of the upper bound, because that may not happen because the sellers are in control, the bears are in control of this move. Okay, so you can keep that at the back of your mind as well. So something else to spot here is that in periods of indecision or low volatility, the bands contract. You can clearly see it here compared to this and this. Distance is much greater. So this is a period of inactivity, which is something we do indeed look for. Okay, so you can play this accordingly. Go short at the top, cover your position here, go long here, cover your position at the upper band of the Bollinger Band as well, or as you see the price action fit. So again, another example, break below the lower bound of the Bollinger Band, you could buy here, but don't have an expectation. You could have the expectation for the price action to go up from this line as well and the upper bound of the Bollinger Band, if and only if there is a reversal, a general reversal of the trend in the horizon, and there's plenty of other technical indicator tools that can highlight this only after it happened. But again, go long at the low when you see the break below the lower band of the Bollinger Band and have your position target for a closure up here. So close the position at the midline. Okay. Again, same thing. You could, for example, close to a break here, but didn't happen. But still, you can treat this as a break or let's just say touch of the upper bound of the Bollinger Band. You could go sell here, can do a short position here, and close your position in the lower bound when you see the break below the lower band of the Bollinger Band, much like in this example right here. Okay, so this one is pretty much similar to this. Okay, can cover your position down here. Or if you are risky enough and this is not enough for you, you could leave the position open because you see not much resistance from the bulls. Therefore, this one could be your next stop. If you, let's just say, have been much more patient and you want more of your trade, if your greediness is actually entering the picture once again. But still, you can go once again, sell here and close the position here, and at the same time reopen a position, go long here because you see the break below the upper bound, below the lower bound of the Bollinger Band, and have a target of the midline as an exit. Or if you're feeling dangerous enough or over optimistic, you can wait for this. Okay, so there's plenty more things to keep an eye on. Those are few strategies you could deploy when using these lower bound and upper bound Bollinger Band breaks. Okay, so moving on to the next topic, which is RSI. I've covered this in depth as well in the prior webinar. The relative strength index. So a relative strength index, RSI, is a technical indicator used in the technical analysis of financial markets. It is intended to chart the current and historical strength or weakness of an instrument based on the closing prices of a recent period. Again, talking about RSI, the RSI uses closing prices for the most recent trading period. That means inherently this is a lagging indicator. Okay, it's not giving you information about the future, even though it gives you real, much more closer to real-time kind of data when it comes to making informed decisions. So it measures what? Momentum. So it's a momentum oscillator. It measures the velocity and magnitude of the directional price movements. Okay, so it uses the historical strength or weakness that we see from the chart, calculates it using a moving average, and as an oscillator, it measures the velocity and magnitude of the directional movement. So momentum, what is momentum at the end of the day, is the rate of the rise or fall of prices. Okay, how fast or far or how slow the price action is moving. This is what momentum is. The stronger the momentum is, the faster the price action is heading towards either direction, upside or downside. The lower or the slower or the how fast, how slow in a sense the price action is falling. Well, in this case, how slow the price action is, it's telling you that there is lack of volatility, lack of momentum, and the price action is not going to go anywhere that fast. Okay, so things are indeed slowing down with low momentum. Fast momentum or strong momentum means price action is heading is moving rapidly and fast. Okay, so the RSI computes momentum as the ratio of higher closes to lower closes, which at the end of the day is pretty simple to comprehend. Instruments that have more or stronger positive changes tend to have higher RSIs than other stocks that have more stronger or negative changes, mainly because we're losing at closing prices. Okay, so what has happened in the recent past, if you see 5 consecutive days of gains, you could see, in a sense, a stronger RSI reading. Makes sense, okay? Because it's a ratio between the higher closes to compare to the lower close. So RSI is most typically used on a 14-day time frame. It's just a plain old rule of thumb. And the RSI oscillator or indicator is measured from a scale of 0 to 100, with the 100 being the extremist of the extreme when it comes to overbuying kind of tendencies. 0 is the extremist of the extreme of the overselling tendencies that the market has. So it's pretty rare, if rare in general, to see values of 0 and 100. I have not seen a value of 0 or 100, neither on a mini chart nor on any given time frame that you have in front of you. Super extreme. What we care about at most of the times is the bands that we do place around the oscillator RSI momentum, which is the 70 and 30, which they are denoting that 70 in a sense is not super, but it's a bullish enough kind of environment if you have a value of 70. If it's 70 and above, that means there is overbuying kind of tendencies. And again, we're looking at the same kind of concept here. We do expect to see the principle of the reversion towards the mean coming into action. Okay, so that's why we pay attention to the breaks above or below the 70 and 30 levels. The 30, obviously, it's a sufficiently strong selling pressure kind of environment around that instrument. So we do look out for that. So below 30 readings are classified as being that instrument is having an oversold kind of condition. So the shorter or longer time frames are used for alternatively shorter or longer outlooks. So more extreme high and low levels, 80 and 20 or 90 and 10 occur less frequently, but indicate strong momentum. So this is a visual illustration. Let's go ahead and look at the principles before we go ahead and do this visual illustration kind of example. So principles: when prices move up very rapidly at some point in time is considered to be that market or that instrument to be overbought, and that has implications, and we look at that on a day-to-day basis. So likewise, when price falls very rapidly at some point is considered to be oversold. So this gives rise for a potential reversal scenario. Hence, technical analysts seek these levels. The level of the RSI is a measure of the stock's recent trading strength. And remember, this is a lagging indicator, it's not forward-looking. So if you have rising values of RSI, that means the proportion of higher closes to higher lowers, the proportion to higher closes to the proportion of lower closes is much higher. Okay, so more trading days consecutive in the greens has the RSI value increasing at the end of the day below your panel. So also something that is super important is the slope of the RSI, which is directly proportional to the velocity of a change in the trend. So the distance traveled by the RSI is proportional to the magnitude of the move. So the steeper the slope is, the stronger the move is, but also the distance traveled by the RSI. For example, if you go from 50 to 70 within 2 trading days or 2 periods, that signifies a burst of just say buying activity, which is a foretelling that maybe more fast price action is going to be in the near future, and that's where you capitalize upon. So it is believed that tops and bottoms are indicated by the RSI much more quicker than price action. So in the RSI case, when it goes above 70 and drops below 50 or 30, it marks the trend's peaks and troughs. So at the end of the day, we also look at divergences between that. For example, RSI is failing to break into and make a new higher high and a new higher low, whereas the price action on your chart actually goes ahead and doesn't that. Okay, this is a divergence. This is something we look out for, and this is a bad omen, if you will like, that the price action is gonna undergo some sort of volatile conditions in due time if enough traders spot this. Okay, so traditionally RSI readings greater than 70 are considered to be overbought territory, and RSI readings lower than the 30 level are considered to be oversold territory. So in between the 30 and 70 level, it is considered neutral. Well, the 50 level is a sign of no trend. So if you see RSI values gyrating around the 50 level, you have enough confidence to say that neither the bulls or the bears are in control of the move, or there is an equalizing kind of force, which can be treated accordingly depending on the situation. That could be a position where you mark as an exit place, or you await looking at that 50 gyration around the 50 of the looking at the gyration of the price action around the 50 level. You could at the end of the day be looking at that and wait for when the break is going to be either above or below, and place an according trade to that direction, the new trend. Okay, mainly because at the end of the day, we do escape a period of consolidation of indecision, and for some reason, the bulls or the bears choose to take initiative of the action, and therefore the new trend is going to move towards that direction. Okay, that's one way to do it. So overbought and oversold conditions. Analysts consider the failure swings above 1730 on the RSI as strong indicators of market reversals. So assume that the RSI hits, what do we mean by failure swings? So assume that the RSI hits 76 and pulls back to 72 and then rises to 77. Now, if it falls below 72, analysts will consider this to be a failure swing above 70. And this is an area that we could potentially capitalize upon, okay, and go short, okay? So finally, chart formations and areas of support and resistance could sometimes be more easily seen on the RSI chart as opposed to the price chart. And that's why we use this area or the usage of the RSI as well as support and resistance levels. And the center line for the relative strength index is 50, which is often seen as both the support and resistance line of the indicator. You can use the indicator as well as support and resistance. So if the relative strength index is below 50, it generally means that the trading instrument's losses are greater than the gains. Makes sense. And when the relative strength index is above 50, it generally means that the gains are greater than the losses, obviously. Okay. If you see a series of green candles, you reasonably expect to see a series of upticking kind of RSI values on the same kind of time frame. Okay. Vice versa is also true. So let's go back to the example and see what we can extrapolate from this. So RSI is below our lovely chart here. Okay, an oscillator. Remember, in this kind of chart, we also have Bollinger Bands. These we also have moving averages, and we're gonna put all of these together to see how they behave together. So periods of indecisions are this. So gyration of the RSI value around the 50 level. You can clearly see the price action is not going pretty much anywhere. Yes, this may be a channel. Volatility is low, and you can clearly see that from the width of the bands. But then you have some sort of erratic swings, and you see the price action falling below the bid line, which is the 50 level. So areas between 30 and 50 are considered to be territory of the bears, whereas 50 and 70 is a territory of the bulls. So if you see RSI values between these two bounds, this, which is in this case RSI value here, okay? So it's within the sellers kind of territory. So the sellers, the bears are in control, and you can clearly see that. Sorry for the not so straight line that covers everything. Let me erase this. Okay. So you can clearly see that from the consecutive lower highs. And at this point in time, you see a break. You can see the clear trend line break coincides with the RSI value moving from the negative territory from between 30 and 50, crosses above the 50, the bid point, and then you see the slope and how fast it has covered the distance, telling you that something happened here and that the bulls are now in control. Okay, so we shift from the 30 to 50 area to the 50 to 70 area, bullish territory. So the bulls are in control, and the fact that we saw the RSI value jumping by this kind of magnitude and this kind of pace and this kind of velocity tells you that the bulls are indeed eager to push the price action to higher ground. Sorry for the not so straight line. You can use this as a support and resistance level. Now is acting as resistance after 1 and 2 touches. Sometime in the future is going to play a role as well. This one is not there yet. Another one here, and then the complete break. Okay. So the price action from there onwards switched direction. So we went from down to upwards. The major reversal has taken place within this kind of boxed area, if you would like. Okay. So in this kind of case, RSI value is above the 15, crosses the 70. So oversold, overbought conditions, you would expect some sort of a pullback, not that much, however, because RSI value stays between 50 and 70. You can clearly see here. Okay. It's above the midline. And after a period of consolidation, slight consolidation within this bound, we see it upticking quite kind of fastly once again at this kind of time frame. And you see also a confluence between another thing, this kind of resistance level. You see a break above the resistance level and the RSI value once again remaining in positive territory, telling you that the bulls are in control and the bears are absent. So another break, could have went long here. Also, you could have gone long here. Okay, having this as a target, and another area you could have gone long is somewhere in here after the break above this support, the resistance level, which has turned into support after this slight fall. Okay. Again, look at the spike of the RSI in this kind of area once again. So break above this new resistance level once again, and you see the slope being super steep. That means a lot of bulls entered the market, push the price action to higher ground, break above this upper bound of the Bollinger, and the upper bound of the Bollinger Band as well, but also broke above this temporary kind of resistance level and made new high. Okay, you could go long once again here, or that position was long as well, and you capitalize upon this sharp rise of the price action, but also the rise of the RSI value. So you see a crossover above the 70 once and twice, and this is in a sense something we will be discussing right now. You can do trend lines on the RSI as well. So you have a high there, another high there, and a lower high there. This one could be what we call a divergence, because I'm going to explain right now what we mean by this. Because RSI values are making highs, okay, then a lower high, and then another lower high, whereas the price action is making fresh high, higher high, higher low, higher high, higher low, higher high. Maybe we're going to see a low here. The fact that the RSI is recording lesser and lesser values, whereas the price action is making higher and higher peaks and higher troughs. Okay, that is an early indication of a divergence, and you could play that accordingly. You could go sell short here or close your position here. Okay, awaiting for when or whether the RSI value is going to break below the 50 level or is going to consolidate above it. In this kind of case, bullish momentum was strong enough to avert or push away the bears from this kind of equation, and the correction and the rebound occurred. You could go long here, or if you've missed this kind of move, you can buy in the dips as soon as you see the RSI forming this lovely trough and rebounding once again. Same thing can be told here. In this area right here, you can go long. It's not going to be exactly straight, but you get the point. Mainly because you also see price action consolidating above the midline of the Bollinger Bands. Once again, you see the Bollinger Bands, the midline of the Bollinger Bands acting as support, but also you have moving averages. You see the clear break below the blue line and the yellow line. So this is what we call a bullish crossover. So you have one indication. Second indication is the break above the resistance level. Third indication is the RSI staying positive. And fourth indication is that the Bollinger Band, the lower bound, the midline of the Bollinger Bands is acting as support. The fifth one is that you see chart patterns or pure price action making higher highs and higher lows. And those are 5 good enough reasons for you to go long in this kind of area right here. Okay. Yeah, that's pretty much how you can use the RSI as an early signal alongside with other technical indicators in order to make much more informed decisions when it comes to your trading journey. So if you guys have any sort of questions, please send them through. Since we have finished this kind of webinar, what to expect in the next webinar, if I'm not mistaken, we're going to go over moving average strategies. Also super important. We covered this partially or super slightly today. Going to do an in-depth kind of webinar next week to see how you can use simple moving averages in your trading journey and how you can capitalize upon this and make money. Okay. I don't see any sort of questions. If you guys are okay with what we have covered today, let's just keep it here. Thanks for watching, and we will catch you on to next week's webinar for hopefully a more insightful kind of content on what kind of things you can use in your trading journey in order to be profitable. Okay. So again, thanks for watching, and we're gonna see you next week. For the time being, take care. Bye bye.